Okay, so let's understand what mutual funds are made of, what are the key selection criteria, what are the key parameters one should look at, and technical criteria is to ensure that the mutual fund that you're investing in makes sense, right? And these again have to be periodically be seen repeatedly to see they are in the same run of activities that you wanted them to. A very important before I start element is to understand that mutual fund is a long-term gig, or it's not a short-term gig. You should at least look at a mutual fund for next 3 years, right? Specifically when you're doing a SIP, like a systematic investment plan onto them. Okay, so it's very important to keep that in mind once you start your mutual fund journey, in case you already not started it. All right, you can do lump sum based on the criteria of the industry or the macroeconomic view, or where or which type of mutual fund that you're running with you want to get into, and whether that particular mutual fund, right? When I said that type, that various types, right? It's right, like it's an equity fund to a debt fund to a hybrid fund, and then there are flexi cap funds and so on and so forth. There are mid cap funds, small cap funds, there are blue chip funds. The list is humongous, and some of them are theme based, some are sectorial based. Some are global scenario, global economic perspective. There is a fund created. So what best, according to what you know and what you intend doing, you choose a criteria accordingly, but use them for 3 to 4 years time frame at least. Okay, people go higher, but if you see the fund is not flowing as per your scheme of things, you might change the fund. But fund should be from a long-term perspective. So putting that basics in place, the selection criteria typically should be, as an individual, should be based on entry-exit load. That means what is the cost of you entering into a mutual fund? Is the cost justifying the way of growth or not? Same for exit. Some of these are free, when you exit, but some of them charge you too much. So be cognizant of the fact. So that whatever growth, suppose you are growing at say 10%, but they take away, or 15%, and they take away say 5% out of this, you come back to 10%. So in case your criteria is 15%, you should target 18 to 20% if there is an entry exit load of 2 to 3%. Clear? So think in that term. Number 2, see the reputation of the mutual fund manager who's managing the mutual fund, right? Very important criteria. And if you know, then check his past and present kind of performances. But always remember, the past performance doesn't mean the future one will also hold true. But this gives you the confidence in the mutual fund manager, how he's gone through his time, right? Suppose you find a mutual fund manager who's waved through his way through the 2008 times. He's managed the pandemic very well, right? So he knows the same person has managed two situations and he exactly knows what works. Then you're good with the next one as well. So that's what a mutual fund manager should be looked at. Look at the ratings. So there are agency ratings like the CRISILs and CRED and the others, right? So many of those out there, or even JP Morgan, or so various large banks, the conglomerates out there, they rate certain mutual funds anywhere in the world. Okay, check the ratings, and based on those ratings, you can get a criteria of how that particular that particular fund is. Okay, depending on the sector that you're looking at, of course. And then key selection parameters, which include, there are ratios which I mentioned, which we'll cover in the subsequent box there. And then is the NAV serving up? That is the net asset value. So you buy a mutual fund by paying a net asset value, as exchange to one mutual fund. So like you buy a stock for a particular price, NAV is the price for the mutual fund. Okay, and it keeps on changing. That means if it's increasing, that means you're growing. As simple as that. So if you buy at lower end, in case you get out, you sell at a higher end. Now, what are the key parameters? Expense ratio, I just mentioned, entry exit load. I mentioned the funds portfolio. That means if you're going in a particular sector, or if you're going into a type of companies, or if you are doing a debt related fund, or you're doing a hybrid fund, that is equity come this, or you're doing only equity fund, then you have to check out the funds portfolio. That means what kind of companies come into play, and those companies are what you can see. That means based on the parameters, which is the ratios we just talked about, right? Including the one that you downloaded. Now, if you understand those and you see these companies are perfect for you and they do, then leave the fund manager to manage it accordingly. Right? So then the funds portfolio is also very clear. Then you do a category returns, right? And category returns typically is the equity related returns are mutual funds were higher, or the hybrid was higher, or the flexi was higher, or one of those theme based, like an electric vehicle was very good some time ago, and then automobile related theme was very good. So is that category returning good? So hence it should be part of you. And will that category keep on returning for the next 2-3 years until the time you're there for, right? Because either you buy a collection of the companies, or you buy into a mutual fund which has those companies in. That's how it works. Okay, that's what you should be thinking. So they are selling an index based on the companies that you're looking, because you can make an index out of various companies in TradingView, by the way, right? Then you'll know how the P is working. So, but if you have chosen some 10-20 companies are working for you, and those companies should be part of a mutual fund so that you look away. You don't have to follow each of these 10-20 companies, but they're part of the portfolio which will definitely go up. You buy that particular mutual fund. Okay, that's how it works. And then you see the risk ratios, right? And we'll cover those risk ratios in the respective technical criteria. Okay, right. So what is the first technical criteria? Standard deviation, right? This shows you the volatility of a particular mutual fund, because a single stock, the way it fluctuates up and down, will also affect the volatility of that particular mutual fund. That's the standard deviation. Okay, so you look at the standard deviation of the fund in its general, right? Because if it consists of 20 companies, 10 of them are fluctuating, maybe 20 years, you will, those 10 stable ones will compensate for the other 10. But if all of them are fluctuating, then you see the mutual fund going up and down so rapidly, you might not know what is happening, right? Because sometimes you might be doing 100% profit, then you come to 0%, and okay, I'm giving you just hypothetical numbers. So standard deviation means that. So check that criteria of a mutual fund, that how is it what is the standard deviation? I mean, how is it getting managed right now from its from a portfolio that it consists of the companies, and if that is going wildly, it is really deviating the way it's supposed to be, then maybe that's not the right one to be in. Also, it should not be fluctuating as often. But yes, if it is a high beta, okay, beta would mean sensitivity, right? If a small change somewhere creates a havoc of change there, either way, up or down, then it's a risky proposition. So whether you want to take as much risk is your thing. But if you see the alpha related companies which with small change makes a big change, right? Big growth, if that's the one, that's the risk that you should be taking into and then running with it, right? So standard deviation is all about volatility. That is what is the fluctuation. Beta is a sensitivity. That means what small news here or small change here can create the either rise or the fall, right? So that's the second element. So standard deviation, beta is that. Sharpe ratio measures the performance of an investment, such as the portfolio of company that we're talking about, compared to a risk-free asset, where there's zero risk, right? Compared to that, how will it perform? And then after adjusting it, so basically what it means is that the Sharpe ratio will tell you, if you adjust your risk, right, to the optimal level, what is the outcome that you can anticipate from your current portfolio of mutual fund. That's what a Sharpe ratio shows you. So that plays an important role. Then Jensen's alpha is one other criteria, right? So used to determine the abnormal return of security or portfolio of securities over the theoretical expected return. So suppose your mutual fund kind of mentions that it has a capability of giving 20% return over the next 3 years, right? Then you put the Jensen's alpha into in play and just see what it means. The theoretical expectation 20%, but from a Jensen's perspective, what it is. That's how you come to know where you stand, right? As simple as that. So that is one of the criteria you can choose for whether it is completely deviated or it falls into the scheme of things that you're looking at. Then there's Trenor's ratio, right? A portfolio performance measures that adjusts for the systematic risk. So the typical example is reward against volatility, right? So there will be certain criteria mentioned to you that, again, an anticipated outcome is so much, the volatility expected so much. Incidentally, for people who don't know, VIX is the Indian index, VIX, or the international VIX is the fear index, right? Fear means how much is the fluctuation within the overall stock market or particular stock, and so on and so forth. So VIX indicates across the stock market, what is the fear that people are facing, and what is the fluctuation between the top and the bottom of the collective stock brought together. So that is what a volatility index is all about. Now the volatility in this case is same, the fluctuations against the reward, how does it fare, is the purpose of Trainer's ratio. Clear? Now we'll quickly take a look at some of the best ones. I'll go to the Indian ones as well as the US ones, so you understand how this works. Okay, so I'm at a site called moneycontrol.com. Anybody could subscribe to it, right? So I'm focusing now on the Indian ones. Now if you see what consists of, right, there's an equity fund, there's hybrid funds, a debt fund, and then there are others, right, which would mean flexi, theme based, this and the other, right? So so suppose you look at equity, right, and then there is selection criteria down, 5-star, 4-star, 3-star, you can choose. So of course everybody will want to use 5, right? Typically, suppose we use 5, and then you start checking the details here, right, all the discussions that we just had. Okay, so if you start looking at it, the historic return, so now you see, okay, so let's forget the first one because it's an ad and they will put their ratios accordingly, so let's leave it for now. Look at the one below, right, SBI Contra Fund, 5-star, the asset under management, that is AUM, is about 5,000 crores, so it's a good, well managed fund, right? It's a large fund. Then what, 1 week return, 1 month return, and so on and so forth until 5-year return, right? So if you see 3-year returns, most optimal, and that's why I was mentioning what I mentioned, right? Or rather 2-year was, so depending on the cycle that you had come into. So so that's right, 2 to 3 year or maybe 3 year beyond is the best ones that you should be keeping, so you get a steady return outcome. Okay, now if you see, okay, so that is that. Then you see the investment returns. Okay, so this is the return by the mutual fund, the investment return, that means how much money you put and how much the outcome that came out of it. 991, 993, right, and so on and so forth. So this was the return against the entire AUM that was put in place. Got it? Then there is a monthly return and so on and so forth. So okay, so these could be normal criteria, date wise and quarterly they'll show you, etc. Then there's a criteria finding rank with category, right? So how does it rank amongst its 55 peers and so on and so forth. So another criteria that can be chosen, picked from. And then point to point return. Now what does this mean? This means that there is against the similar funds in the industry, from a point A to point B, how much was it coming about, right? So annualized return of 30% is very high, guys. So this is very good to have that. And the absolute return is a simple return. Okay, this is annualized return is year on year. This is from the year to date. That's how it is. Excuse me. Now with that said, let's jump into SIP returns. I actually want to show you a specific one, like risk ratios. Yeah. So here's the risk ratio. Now, if you see the risk ratio, right, some of the standard ones you talked about, the standard deviation. Okay, so let's look at the first one itself, 19.94. Okay, the deviation is very less. So that means it's fluctuating less compared to all the one below, right? So this proves to be a good one. Then there's beta, sensitivity, right? How much it can go about with small changes. Above 1 is always bad. So below 1 is always good. So all these are showing mostly below 1, right? So below, lower the better. That's how this works. So that's beta. So it's showing good one again. The Sharpe ratio, if you remember, right? We discussed. The Sharpe ratio is about 1.3, 1.0 and so on and so forth. Now, okay, criteria typically is between less than 1 and rather less than 1.25. That is the criteria, the industry criteria. Less than 1, the better. So there is this little high of sorts, right? And what does this mean? So if you remember, Sharpe was all about the risk-free adjustment, how much it can give you. So if there is no risk, this is the outcome, right? Very good. So with risk, it was higher. Typically, when you do the rather, you will get a higher value here if the risk was higher. Now, when you adjust the risk, it's still giving you a higher value. So 1.5 and below is good, higher the better. So 1.3 is a good one. So the first one is turning out to be a good one for almost all criteria right now. Jensen's alpha, same story. Trainer's ratio, same story. Okay. So so if you see trainers, so Jensen's alpha 10.54, what does it mean? So Jensen's, for example, shows you the theoretical value what you would get otherwise, right? So 10.54 is again good, right? 18.45, another good one. This is quant. So these ratios, again, when it's high, it shows you how confident are these guys to give you an outcome for, right? From an expected perspective. Now, Trevor, for example, 0.3, 0.23 and 0.25 is all a reward against volatility. So, so the volatility is X, the reward is Y, right? Now, if the volatility is, if you understand, right, if you check the volatility, if it is high, right, this value should be down. And when it is low, it should be high. That's the way it works, right? Inversely proportional. So currently in the markets, if you realize, right, as we stand today, the volatility is very high. Okay, so it's giving you a ratio, which makes sense. Okay, against the reward, anticipated reward. Okay, so that means it is managing the fluctuations well and giving you certain outcome, which from a 0.3 perspective is good from a trainer's ratio perspective. All right. So anything upwards of 0.25 is considered all right. Okay. There is no criteria, there is no rules against this, but generally the good ones seem to be like this. Okay. So with that, this gives you a view on how it typically, you can check one of the best ones and start using based on the theme that you choose, based on the criteria you have, and so on and so forth, right? So then you see, right, these are portfolio, and if you dig deeper into this, it will show you the portfolio. For example, I clicked on this, it has the following portfolios. It's giving you all the details here. And then you see it consists of all these banks and, various. There's a fantastic set of companies here, guys. Fantastic. So this looks like a good one. I would have gone for it, unless I already have it. Okay. So that's one. Then you should look at, okay, so you can go dig deeper and see the portfolio, etc., and then you can manage against whatever your learnings up till now for a large term, a long term portfolio perspective. Then you look at the NAV details, cost wise, right? What does the current NAV stand for? So 1 day change is 1.53%, 52 high was this much, and etc. So you check your NAV based on high and low, where you stand right now given the current scenario, and you enter accordingly. As simple as that. 52 low was 197, 240. So anything between 240 and 197 is good. You should not go at a very high level unless you see this going really up based on the criteria decide for the long term portfolio this holds. Okay. So this is what it is. And the current one showed is 230, 240. Yeah, okay, so I would wait a little bit. All right, with that said, look at the US ones. Okay, this is a site for money.us news, right? Now, if you see these details, right, so they're giving you expense ratios, they give you total. Now, if you go deep, go deeper into this, and you can search and select which ETF and which details, and give you further details. Some of them are subscription based. Now I don't invest so much in ETFs, and I invest in ETFs but not in mutual funds in the US, and so some kind of a chart in what it does, and you get the details of returns of those specific ones that we just went through. All right, the diversified bond fund, this consists of these. And there'll be very few, right? So the monthly returns are negative and so on and so forth. So ETFs can be seen, or mutual funds can be seen from this perspective. You see the performance, you see the fee, and you take your call based on these details. Those ratios are will be mentioned somewhere, I think. Yeah, so there is an interactive chart. So Sharpie ratios were mentioned, of course. So this is how you do this, guys. You have to go through and dig yourself deeper. If you have the potential, or you really are aggressive towards finding that cumulative growth, or you can choose to give it out, right? I do my things on my own, as I told you, And because I do this once in a maybe 2 years, 3 year time frame, and I know where it stands, I just check it on maybe once in a quarter or maybe twice in a year at best, right? And look at these things from a long-term perspective. You can follow the same thing if you want to. Okay, so you got the ratios, you understand how to select. I talked about certain platforms that you can use for, and then you buy it from respective, again, the platform that you choose you want to buy it from, but analysis can be done on these, and you take it from here. Okay, now in the next section, okay, I'll probably you require to go to a challenge first of all. So let's go to the challenge first, because the last section of the day is all about which platforms can be used for this. Okay, we'll go there in a minute after the challenge. I'll see you in the challenge though.